Hi, everyone. This is Maheen, and welcome to the Canadian SME Small Business Podcast. Today, we are looking at the financial health of the Canadian small business sector through the lens of data. Now, in 2026, the economic recovery isn't hitting everyone the same way because we're seeing a significant divide where some sectors are thriving while others are struggling under a growing weight of debt. And today, joining us is Jeff Brown, the head of commercial solutions at Equifax Canada. Since 2016, Jeff has been at the forefront of credit innovation, helping organizations and policymakers understand the complex signals in commercial data. He's here to discuss the latest findings from Equifax's Market Pulse report and what the rising delinquency rates in certain regions mean for the future of your business. So lots to cover today. So without a further ado, let's dive in. Jeff, it's a pleasure to have you with us. Welcome to the podcast. How are you?
I'm great. Maheen, thanks so much for having me.
Very pleased to have you with us. Now, Jeff, your latest Q4 data shows a widening divide across sectors and regions in Canada, meaning that we aren't all in the same boat anymore. Please tell us, what is the biggest misconception about the small business credit stress in Canada today?
Yeah, absolutely. So, everything we look at in terms of, Bank of Canada holding their interest rate, the wars that are going across the world, the tariff disputes that are happening as well. Um, e- Everybody seems to think that this is common certainty that everything's coming down all at the same time, and it's really hitting different sectors in different ways. I will say that since the pandemic has happened, we've seen a change in the language of credit as well. So while all these things are going on, the banks, lenders, suppliers are changing the ways that they operate with small businesses as well. So you may have seen a credit application that you'd had to fill out 4 or 5 years ago, and banks would be really interested in the past, few years of your performance, your sales, how you've grown, and really that's almost like a hindrance to a lot of businesses now because really since the pandemic, people have been carrying a lot of debt. And so a lot of the questions that are being asked now are what industry are you in? Uh, you know, where do you see white space? And they're really more focused on business plans because you can't really rely on the past history, all this debt that's really sat there. So really there's an advantage to being a small business that's just emerging now because you're able to see the businesses that failed here over the past few years. There is white space that's open. We're coming out of an area where, 18 months ago, we were seeing the largest year-over-year increase in bankruptcies. And so now businesses are just starting up. They don't have that debt. They're having, different types of applications are filling out with suppliers and banks. And we also have a net new kind of savvy small business as well, that there's zero loyalty to banks. You're looking for the best credit programs, the best lines of credit available. And that varies based on business. Varies based on the area of the country that you're in as well. So it really kind of depends on who you are. If your business has been around for a while or one that's been around just opening now, your risk, your view on the country, and your impact is very very different right now.
Right. It's quite clear that a one size fits all view of the economy is no longer applies to the diverse reality of Canadian SMBs. Not just let's explore the growing gap between how businesses manage payments to banks versus suppliers. Tell us, what does the gap between bank and supplier payments reveal about SMB cash flow priorities?
Yeah, absolutely. So it's a great question because we can really tell a lot about how a business is operated based on the type of payments they're making to their different vendors. So at Equifax Canada, we really things into two different buckets. We have what we call as trade payments. So it's a relationship with your supplier. So if you're a restaurant, it's the food delivery systems, it's your refrigerators, it's the things that you have terms on. So you're buying a bunch of goods, you're buying pepperoni if you're a pizza shop, and you don't have an obligation to pay that back until usually about net 30, net 45 days, depending on the industry. And so when we see small businesses really focus on paying those supplier relationships back stronger than their relationship with the bank, which is the other quarter that we look at, it really makes us see that they're really just trying to keep their head above water. They're trying to make sure that the business continue to operate. And in this present economy, what we're seeing is that those relationships are really being focused in on, and your credit cards, your lines of credit, your mortgage, if you have one as a small business, that's really not being prioritized the same way. So you're lapsing on those payments or paying back a bit later, and you're just focusing on those suppliers. So you're making sure that you have products to create, services to deploy so that you can keep an income happening with your business at the detriment of your relationship with the bank. And really what that is kind of kicking the can down the road is all those financial products have interest rates. They have things that accumulate. So might be good to operate now that you can kind of keep things running, keep your doors open, but eventually, that interest will accrue and it will gain traction, and it'll actually reduce your ability to grow your business, hire on that new staff, to buy a large piece of equipment or a vehicle to help your business kind of grow and succeed. So really, that's what we're seeing in the economy right now in the major provinces that have the most small businesses that are being tracked right now.
Right. No, you're absolutely right in terms of prioritizing suppliers to keep the doors open while falling behind on bank debt is a telltale sign of business under extreme cash flow pressure. Next up, Jeff, let's explore and discuss how financial pressure varies from across provinces and sectors. Which regions or sectors in Canada are facing the most financial pressure right now?
Yeah, so it does vary. So when we look at things like real estate, so real estate has been an area that has a lot of compounding industries that fold into it as well. So whether you're having a real estate in downtown Toronto or downtown Vancouver, really those properties aren't turning right now. So there's kind of an area where people don't want to go through and invest, or the cost to actually operate there is more than you can potentially bring in. So it's really going to affect your margins. If those businesses aren't turning, it means you also can't get trades in there. So if you're going through and upgrading a facility, a location, also things like the cost of steel. Cost of steel has gone dramatically higher. So anybody who wants to go through and build something is kind of holding back and developing. So you think of all the trades, the transportation of those goods to those locations. Real estate is really being affected in our major cities across Canada right now. Outside of that, we look at things like manufacturing. Manufacturing last year, as the tariffs were really sort of announced and I guess inflicted, we were seeing specifically in southern Ontario, really the manufacturing of automobiles, and really the shutdown of jobs losses, and the ability to really kind of question its future. So there was a big impact on that last year. It's still happening, but we're seeing it at a decreased rate. So the tariffs that were put in play, nothing is necessarily going through and being put to a higher degree, but what's there has been, I guess, somewhat stable. Obviously, not in a positive outcome here over the next few years, but not to the same levels. We're not seeing that same level of decrease. So there are vehicles being manufactured. There is products and services that are being manufactured in Ontario, just not to the same levels as we had over the past couple of years. So manufacturing is one that we had kind of our eye on, but it has somewhat stabilized for the time being. I guess that being said, I mean, we're living in a very dynamic economy right now where everybody's watching the news, and what happens tomorrow, is going to affect us for the next few months as well. One of the things that's really happened here over the past couple of weeks, I know we're talking about trends that happened late last year, is the oil industry. The price of oil is going through the roof, and really, no matter what business you operate, you're going to be affected, whether or not it's you or your employees coming into work. It's you distributing goods. It's you shipping goods out across, whether it's within Canada or globally. And the transportation sector itself. We have an economy that's a gig economy that's grown quite a bit. People who are have ride sharing services that they offer through their vehicles, kind of outside of their 9 to 5. That affects them as well. So it is kind of a cascading impact of what's happening really across Canada right now. So whether it's manufacturing, real estate, the general transportation industry, there's quite a dynamic that's happening right now in Canada.
No, you're right. I mean, when localized stress narrows into specific industries like real estate or finance, it can really tighten lending conditions for everyone else as well. And to all the business owners that are watching us, I mean, in 2026, we cannot afford to fly blind. Equifax data shows that debt loads for newly established firms have surged by 64%. So if you're a young business, your leverage is your greatest risk. So please get a clear picture of your credit profile today so you don't have to become a statistic tomorrow. Now, Jeff, let's look at why business debt is rising, even as fewer companies miss payments. Why are business debt levels rising, even though fewer companies are missing the payments?
Yeah, so I mean, the cost of operating a business is growing exponentially. And one thing that when we're talking about debt, there's definitely the areas of bad debt, but sometimes debt's a good thing too. So we talk about looking at debt levels for net new businesses. That's really not surprising. So it has grown quite a bit, but it also it's new businesses that are going through and seeing that white space, taking on debt to be able to kind of grow and establish their space. So when we think about things like the oil industry, the transportation industry, equipment leasing and financing. So it's these areas that have the potential to grow, where you actually have to have a rapid course of investment to go through and enter through these spaces as well. So while that's a kind of thought to be a bad word, it's also a signal that businesses are seeing the opportunity to go through and invest. And so it's really interesting to see, especially as we get into the spring and summer months, where Canadians typically feel kind of that entrepreneurial spirit, and we see the most businesses open up. We will see those debt levels rise, but typically it's a rise at the beginning of the first couple of years as the business has established itself and its customer base, and then there's kind of that ebb back down where they find their norm, they understand kind of who their customers are, what their employee base looks like, and can really kind of set their business plan moving forward. So it is an expectation for every business that's trying to be successful that there is going to be an investment there. But that being said, if you're a business that's setting up in a major city right now, especially look at cases out in British Columbia where cost of living is very expensive, the cost of rent isn't going down fast enough for businesses to set up. So anybody who's operating kind of in the fringe and doesn't necessarily have a high cost of rent are going to be the ones that succeed here over the next few months as we look at the real estate market trying to settle itself down a bit. So
Right.
yeah, debt levels will increase because cost of living is increasing as well.
The businesses are clearly restructuring into fixed term loans to manage their survival that we're talking about, and even if it means carrying a heavier long term burden. Finally, Jeff, let's explore what these trends signal for the future of lenders and business owners. Which indicators should businesses and lenders watch to understand future credit risk?
Yeah, so it's an interesting question because when we think about in business credit, we think about it in kind of a negative credit life cycle as well. So typically, if you're paying your trades on time, your account receivables are in good order, you're fine. There's nothing out to watch out for. But we would look at delinquencies, anything that's 30, 60, 90 days past due, that goes into collections, legals, and bankruptcies. So really, when we have a stabilization of the Bank of Canada interest rate, it's a sign to us that you know that the economy is not necessarily in a positive state right now where they're expecting a high amount of lending. So we really look at those 30, 60, 90s. When we go into an area where the economy is really, really soft, we see an acceleration of companies going from missing a payment at 30 days plus past due right through to 90. So it's a really slippery slope. If you miss one payment, the likelihood of you going through and missing it at 60 plus is astronomical. So there's a lot of organizations right now on the collection side and large suppliers that are really watching that space. That if you miss one payment, they're going to be picking up the phone. And really, what we tell small businesses in this space, if you think you're culpable or that you're going to potentially miss a payment, is pick up the phone, talk to your suppliers. They want you to succeed. They want you to be there as a customer moving forward. And so if they have to extend terms by another 10, 15 days, the likelihood of them doing that for you grows if you let them know in advance. If you do it after that 30-day mark, if that's your net terms that are in place, it's harder for them to advocate on your behalf. They want to go through and make sure that you're a continual customer, that you're buying products from them, that you have that relationship. And so doing that in advance, especially in this economy, is really, really important. I won't draw any parallels directly to what happened during the pandemic, but everybody watching for those signs. They want you to succeed, and things like payment holidays or being able to reduce your credit limit that you have with a supplier, even with your bank, so that you can succeed moving forward. They want to invest in you now because it's harder for them to gain net new customers as well. So they will be invested in you staying versus then you leaving as well. So just have those conversations where you can in advance, because again, if you have it afterwards, it's very, very hard to dig out of a hole like that.
Monitoring early warning signs on newer accounts will really be the difference between proactive growth and the reactive recovery. But this was a great conversation. Thank you so much for sharing such great insights and information from that survey, Jeff. And as you wrap up now, if there's any piece of advice that you'd like to give to the business owners that are struggling with rising debt and interest rates, what would it be?
Well, it's a great question just because, again, the world is changing. I will say, I take watch on kind of what the large suppliers are doing. So a lot of conversations we have with big organizations that invoice tens, if not hundreds of thousands of small businesses, is their contingency planning. So whether you think you're affected or not, the potential CUSMA negotiation is happening kind of this summer. It means that if you have any dependency on any services, solutions, or customers in the United States of America, you really need to take a look at kind of the trade agreements that are being established by the Canadian government right now, to know what your plan B is. And just, right now is the time to test and to kind of explore. Because really what we're talking about right now is it's easier to destroy things than it is to rebuild. It's, so kind of the analogy that we use um, is it's kind of like a forest fire happening. What the federal government's doing is making sure that forest fire happens in a controlled burn. They're making sure that the things that are going to be kind of torn down, or the infrastructure that's there, that it's at least stays down in a way that is manageable. These trade agreements are then sowing the seeds for that future forest that's going to be put in place. And what they're going to be doing is likely putting in the credit facilities and programs in place so that the things that we need to replace with are going to grow as fast as they can. So keep it kind of watch the trade agreements that are being put in place, watch for the programs and the initiatives the federal government will be putting in place to help support moving forward, and just be ready to pivot. Nobody likes to go through and talk about change, but that's the environment we live in right now. We have to be ready for contingency planning. A lot of these large organizations are doing that right now. When you might not feel you have the bandwidth, a little bit of work and investigation now is going to pay dividends down the road. It's essentially an investment in the continuation of your business if you plan and collaborate properly.
Right. That is a great reminder, really, Jeff, that financial literacy and data clarity, they are the small business owner's best defenses. Thank you so much for joining us on the podcast, and thank you for sharing such great expertise and your insights.
Thanks so much for having me.
And listeners, that was Jeff Brand from Equifax Canada, a masterclass in why understanding your credit data is the most important step in protecting your business's resilience in 2026. Thank you for tuning into the podcast. Please be sure to subscribe and visit CanadianSME.ca for more resources. A special shout out before we leave to our partners, UPS and ADP, for their ongoing commitment to empowering small businesses across Canada. Please keep thriving, and we'll see you in the next one.